Hello and welcome to Investors Hangout, your weekly guide to making smarter investment decisions. This series is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, post-budget 2025, in all likelihood, you'll have more cash in hand. With that cash, what do you plan to do? Do you plan to spend a little more or maybe save a little less? Well, then watch today's episode because today we'll dive into the impact of this shift and how you can still stay on track and create more wealth. Welcome, Dhirendra.
Thank you.
Now, the first question, you are a mutual fund historian. So from years of experience and interactions with long-term investors, with investors as such, what do you think, how much of investors' discipline has been driven by these, tax-saving instruments, and what might motivate them to still stay on track and, save for long-term wealth creation?
No, one is that, it has little less to do with history of mutual fund. And it has more to do with the Indian savings psyche, the habit. Most people, they are being taught at home that you must save. What you do with that saving is another story, whether you put it in the locker, keep it in the bank or whatever. And going by this tax saving fund is a new phenomenon in the sense that, only from 2005, it became possible. Before that, the tax saving fund allocation, the maximum that you can invest in a tax saving fund to get this Section 80C benefit now, which erstwhile was called, prior to 80C, it used to be called Section 88A, where the maximum investment that can be made in the tax saving fund was only 10,000 rupees.
Oh.
So in the 90s or in the early 2000s, the 10,000 rupee investment that I have made, and I still hold them, I find them to be magical. But I find them to be magical simply because, I've held it for 30 years, In fact, the secret lies in the years, not in the, not just equity. And then, there was no other simple equity investment available. And there was another, charm of these equity investments in the tax saving fund. One is that, investors used to get excited about equity once in a while. Every few years they will get excited. So they got excited in 1992. They got excited in 1999. Then they got excited in 2006-07. And when investors will get excited, they will invest anywhere. And they will generally get excited when the money has been made. Everybody is making money and they seem to be missing the bus. In that situation, what happens is that you invest and normally it is an inopportune time. You lose money and then you take out. And then this is a permanent, embedding in your mind that invest in equity, lose money, and it is a nasty place to be there. The tax saving fund, what they used to do is, or what they do is, you invest and you can't take your money out for 3 years.
Right.
Not taking your money out for 3 years actually changes the whole complexion. Your experience improves. The worst case is that, you will earn little less or as much as the PPF. But the best case scenario is that you invest for 3 years, it has done well, and you keep holding it for a long time. And then it turns out to be very rewarding. So the tax saving funds were a huge catalyst because savings and investment was not in question for Indians. These enabled was savings, investment, and compounding at a higher rate, and being forced to hold on. And that, I think, was quite useful. And that has been a gateway investment for most Indian investors into equity market, which has also been a pleasant experience.
All right. Now, in current scheme of things, when tax-saving tools like ELSS and PPF, they might lose their appeal. So how can investors still develop frameworks or tools that can, help them keep on track?
There are broadly three kind of people, people in terms of their behavior for financial product or investments or long-term investment. One is that there are people who will save, irrespective of, they have to save taxes or not, but they will save and they will invest. On the other extreme are the people who will earn whatever, but their needs are so much that they will borrow future income to spend. Then there is a third person who does not have the resources. He earns, and on the essential thing it is spent. And if he was forced to invest, which will get him some tax saving, that guy will be, will actually be, he will not be able to, he will never be forced to do it. And that kind of person, will be, left out. But there are ways, I think, these things keep changing. They are not static, initial phases you may not have savings, but subsequently you will have. In that situation, I think, people just need to do 2-3 things. One is that think of your important long-term goals. Government has given you all these flexibility. Earn, do whatever you want to till you are earning 12 lakh rupees. But you have to worry about your own future. Your child will get into the college. You will think of buying a house. When you plan to, and just put those numbers alongside. Just have some framework and, come to Value Research online. Look at your goal planner. Look at that, goal calculator. How much money that you need, and for that, how much you need to save. If, having this at the back of your mind will keep you on track. You don't need framework. You just need, it's an extremely disciplined thing when you have all the needs which are to be met today. Taking money out from those and actually putting it to on the side for that important goal, because if you don't do it, you will not have it. So sensitivity to important goals and working towards them, and just reminding yourself every year that what are you working at.
All right then. So are there any practical strategies that can help investors, keep a balance between enjoying the present and, save for future as well?
When you have limited resources, then life is all about balancing it. So in that sense, you will have to, but at the same time, I think what I said that, just being sensitive to your important goals, child's education, not negotiable. Child's, buying a home, if that's a goal on the horizon, then your retirement, I don't think these are negotiable goals. And if you don't have any context of how much you will require, when do you need it, how much will be enough, so that you are not left in a situation and you have to work for many, many years towards these goals. It may not require a lot of money, but it will require discipline, it will require habit, it will require, that orientation. So developing that sensitivity. And after that, I don't think there is anything then just one thing, which is, the temptation to borrow money and spend it right now is very strong, and it is readily available. It has never been in the past. So not being impulsive about your big spending, and that is actually the ploy. The guys would like to make you spend all the money that you have. In fact, not only all the money that you have, the money that you'll have in future. Ask some questions about it, that what is the worth of this spending, how crucial it is. And that matters only in the initial stages, because developing that understanding that what is the worth of it, is it really worth it, what is the equivalent worth of that in terms of future savings and investment and accumulation for an important goal. So just being sensitive to it, asking questions, and once you have that margin, so spending is not all that bad. Just that it should be, you have to strike the balance.
All right. So given the fading role of tax-saving investments, if you had to list 3 most critical steps or say tools to future-proof your wealth or finances.
Besides all the things that I've said, that, develop a sensitivity, get little disciplined, be aware of what you're spending on. Besides that, I would like to, somebody to think of 2-3 things. One is that, form your habit irrespective, because, government is getting out of your life. That's a good thing. Earlier, government was forcing you to invest wherever, and so getting that freedom is important, but you have to worry about your goals yourself. Second is that, do that planning, that how much will be needed for important goals, so that you have some framework. Otherwise, it will look like, your child getting into school and you need some amount of money and you just don't have it. That will be deprivation. That will be depriving yourself an opportunity which otherwise will be, and with normal income, with normal steady income, you will never have that headroom. Third is that, automate. The good thing that has happened is that you don't have to go anywhere. If you have a smartphone, if you have the connectivity, if you have the Aadhaar card, and if you have the PAN number, and if you have an online access to bank, 5 things, you are all set. You can do it any day, yourself, and seamlessly, and in 15 minutes, and entirely a digital process. This SIP thing, a lot of people think that, it's magical. It is magical. It is magical because it is able to automate things. You just give a standing instruction, take away 30,000 rupees from my bank account every month. And you can automate it in a manner that it takes away that money before you start spending. If you have that money lying in your bank account, then the mere access to it tempts you to spend it. So accessibility actually catalyzes. So if you are able to do these 2-3 things, sensitize yourself, form that habit and automate it, and then get up one fine day after 3 years, and then I don't think you need to really come to me to get persuaded. The impact on your own mind that, if you start doing 50,000 rupees, 5,000 rupees or 50,000 rupees and 18 lakh rupees, which you never had, is your contribution, and that has become a very sizable amount. And that does the magic. Once you are sold on a concept and how it works, and it, despite ups and downs, despite the concern, despite the madness in the market, then you don't need that persuasion, and you don't need the nudge from the government.
Right. So stay disciplined and invest consistently. Now, moving on to the viewer's question. Ravi has sent in this question, and he says, I have to achieve a target of 1 crore in 5 years. I can shell out up to 1.5 lakh rupees per month as SIP. So which fund category should I choose in this case?
He can accumulate 1 crore rupees over next 5 years by putting 1,50,000 rupees every month, by just earning 4.5% or about 4.25% thereabouts. So it may not necessarily take a market risk. By putting in a very conservative fund, he can achieve that. But I would urge him that if it is for a little negotiable goal, little negotiable in terms of time, then I think he should take some measured risk. And that by measured risk, I mean, taking some chances where that it will be a little more volatile, but, he runs the possibility of, accumulating something very meaningful. If he's investing in a balanced fund or a aggressive hybrid fund, it will be relatively stable, 5-year time frame, and little flexibility if he has. And that way he will be able to, accumulate something very meaningful, much more than 1 crore. And if he earns as much, as the 2/3 of the long-term average from equity market, or from these balanced advantage fund, or the aggressive hybrid fund, and only 2/3 return, not what they have been able to deliver over a very long period of time, then he will end up with something like 1.25 to 1.5 crore rupees.
So if you found this discussion valuable, like, share and subscribe to our channel for more expert insights. Stay tuned for the next episode.